All right. Well, thank you everyone for attending. We'll be getting started. This is for July, our monthly market update webinar. I will start with disclosures. Silverstone Financial LLC is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Please be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategies discussed in this presentation. And of course, past performance is not indicative of future results. For additional disclosures, check out my website, silverstone.financial/disclosures. Throughout the presentation, you can use the Q&A button at the bottom of your screen to submit any of your financial questions, economic questions, and I'll try to address them at the end. For any personal questions, you can email me at jeremy@silverstone.financial. We set up a time to talk and answer any questions that are more individual to your situation. All right. So for those that are new, my name is Jeremy Eppley. I'm a chartered retirement planning counselor, accredited portfolio management advisor, and accredited investment fiduciary. You can check out my LinkedIn to learn more about my experience and qualifications. And for Silverstone Financial, the firm, we're a fee-only fiduciary registered investment advisor. We provide wealth management and financial planning services to individuals, families, and businesses across the U.S. To learn more about us, you can check out our website again, silverstone.financial/about us. So we'll hop right into the notable events from last month. It was a very eventful month. One of the first things that happened in the month was an interesting Treasury Department announcement. It was good news, which is good. It was that the Social Security Trust Fund was now able to pay full benefits until 2034, which is 1 year longer than was previously expected. They announced that Medicare Part A would last until 2028, which is 2 years longer than they expected, and that disability insurance is now able to be fully funded for the next 75 years, which is the target, but was not being met beforehand. They credited a stronger economy in 2021, which led to higher payrolls and income taxes and lower disability rates, less payout to those that are unemployed, which was very high during the pandemic, of course. And overall, it's great news, although it only lasting the trust fund only lasting until 2034 can be worrisome, especially those that have Social Security as one of the major funding components of their retirement. And it probably affects us, those that are in our 20s and 30s, a little bit less, because mostly rewrite off Social Security entirely. It's difficult to fully expect it'll still be around when we're 60 or 70, but hopefully it is. We'll see. The next big announcement we were hearing about was about the new bipartisan cryptocurrency regulation bill. I'm very excited about it. It hasn't passed yet, but it's going through committees in Congress, and there's some expectation it will pass. Essentially, it would be considering Bitcoin and Ether, which is the cryptocurrency that is on Ethereum, the Ethereum blockchain, as commodities, which would be regulated by the Commodity Futures Trading Commission, and many other cryptos that aren't essentially large enough or decentralized enough that are basically tied to a company would be considered securities, which are regulated by the SEC. Now, personally, I really like what the bill says. I won't get too much into it because a lot can change from announcement to actual passing. But I really like how they're handling it. Personally, back in 2017, when people were asking me, what is cryptocurrency? Is it a currency? Is it a commodity? Is it a security? Is it something else? I always was saying that it's a commodity. Bitcoin has a lot of the properties of commodity, and it makes the most sense to me for that. And a lot of other cryptos that come about that came about with the big boom in innovation in the crypto space are really securities for a lot of them. They raise money for a company, and it's seen as an investment. It meets all the requirements. I believe it's called the Howey test, which determines if something's a security or not, which would then require it to be registered with the SEC. So good news. Hopefully it'll bring some more legitimacy to the space and reduce the scams that you can see constantly, which is unfortunate. Another big announcement from the government comes from the Security and Exchange Commission, and they have begun to lay out plans to remove payment for order flow, which is a big announcement, even though many of you might not know what payment for order flow even is. So what payment for order flow is the brokerage that you're using to buy and sell securities will get paid by a big market maker to funnel their orders through them. And the market maker is able to use that data, is able to take the other side of the trade, is able to possibly not give best execution, which is what worries the SEC. Now, overall, payment for order flow has done a lot of great things for the industry. It has brought about $0 commission trading. It was first really championed by Robinhood and then made ubiquitous by Charles Schwab. Most brokerages use it now because that's the only way they can compete and still make some money. Charging commissions is an older way of doing business that's no longer really acceptable to consumers, but it's possible to see that come back because the SEC is considering requiring all orders to be sent to auction, which would ensure best execution versus a single entity claiming that they are giving best execution. So we'll see how it all works out. Disclosure, my own custodian, I use Altruist. They use payment for order flow to generate revenue, and I see it as a fair business model in general. But I'm pretty neutral, and we'll see if it does come about and if they remove payment for order flow. I'll discuss it more if we get more news about it. So continuing on notable events, there's a lot that happened this month. That's why I have 2 slides. Is the Celsius crash. So last month we talked about Terra and Luna, the crypto and stablecoin that crashed in May. And this is a continuation of the unraveling of a lot of the crypto space. It's very .com bubbly, where there's a ton of innovation. There's a lot of companies. They come out on really high valuations, and now some of them are going bankrupt, and that's making everyone worry that, well, maybe none of these are worth anything, or maybe we've been valuing them too highly and not considering the risk high enough, which is what I believe the case to be. Like we saw back in the day, Microsoft went into the .com bubble already being well known, and it suffered in the .com bubble, but now it's a very large company. And there were Amazon that came through it that was not really well known, and then was able to become a massive company. And then there's a myriad of other companies that went through the .com bubble that we don't even know the names of because they just poofed and they're no longer part of our history. And I see that very much to be the case right now. There's kind of a cleansing happening in the crypto space where a lot of these projects are going under because they were too aggressive. They were there wasn't the regulation or the consumer base to support this stuff. And if I'm making parallels here, I would consider, say, a Bitcoin to be a Microsoft who's well known, but it's going to suffer short term, but it'll come back and eventually because it's so big already. And then there's going to be a lot of random cryptos that are going to go out and will never be remembered again. And then there's going to be 1 or 2 out there that's going to be the next Amazon that's going to do really well. But I don't know which one that is, and no one does. So the Celsius crash has caused quite a few problems in the crypto space. Essentially, it was a run on the bank. What these brokerages and crypto lending platforms have been doing, so Celsius, a crypto lending platform, is they have added disclosures to their filings that say, if we go bankrupt, any money that you have deposited or held on our brokerages or lending platforms or anything is now ours, and we're going to pay our debtors, our creditors, with your money. And essentially, that's a risk that users have to take on. There is another one, Babel Finance. It's an Asian-based lending platform, and there are a few other exchanges and brokerages that people are worried about since Celsius has frozen withdrawals and is expected to go bankrupt and to pay off their debtors with the money of their consumers. It's important to note that none of these brokerages, these lending platforms, these stablecoins are FDIC or SIPC insured. There is no backdrop to fall back on, and it's because there isn't regulation there. Regulation in general is a really good thing and provides protection to consumers. So I'm excited for that bill that we talked about earlier to pass, which would help prevent a lot of this stuff. Just to add one last part to this crypto story, Celsius was offering up to 18.6% interest, APY per year, on money that was being lent to them. Now, that's basically what credit cards charge you. So all that they had been deposited on their platform, they had basically a credit card bill to pay. And to do that, they went out and they invested and lent money to hedge funds and other really, they invest in really risky ventures that it doesn't go straight up. A lot of them will go to zero and it'll be volatile. So you can't pay out consistently weekly percentage percent into interest. And it makes a lot of these platforms and these stable coins and other stuff not sustainable. So it's dangerous. Be very careful. If you do have money in crypto, put it on a personal drive. Don't have it in these exchanges, and use the old good adage that if something seems too good to be true, it probably is. And buyer beware. Avoid it. Moving on, the very simple, quick story is the Amazon's 20-for-1 stock split. It occurred on June 6th. Alphabet's going to happen this month on the 15th. Alphabet is Google's parent company. And both of these stocks were over $2,000 for years. There's been a lot of clamoring for them to do a stock split to help smaller investors be able to afford these stocks. A lot of platforms offer fractional shares, but it's still not as clean as having a true stock split. To note, stock splits don't provide any extra value to the shareholder, but oftentimes go up because more people can afford them. So don't be buying these companies just because of a stock split, but it's good to see these becoming a little more affordable for people. The last two notable events for this month was the inflation headline and the federal rate, the Fed rate hike, which I'll discuss more next slide. But the May inflation was 8.6%, which was worse than expectations across the board on every single line item, because these inflations have multiple items that contribute to it. It was pretty bad. So it was expected 8.3, actual 8.6. April's was 8.3, expectation 8.1. So this one was accelerating in the wrong way. And that scared a lot of people, which is why June was such a tough month, which I'll get into the performance charts in a bit. But we're going to have to hopefully see inflation peaking. One thing to remember, inflation data is backwards looking. It's a lagging indicator. May's inflation data came out in June, and we're only really digesting it now in July. So it isn't necessarily the best indicator for predicting what will happen or for making decisions on your investments today. But I'll discuss that more in a bit. So talking about future expectations, the Federal Reserve is driving this market right now. And we've seen 4 of the 8 meetings this year, 0 basis point hikes in January, and then accelerating every single month, March 25, May 50, June 50, or June 75. Now, the May meeting was extremely important, but the June meeting was even more interesting than the May meeting. So in May, they had announced, for possibly the first time ever, it's not a common occurrence, it's very strange. I'm noticing, did I not share my screen? I'm sorry. Oh, I did have my screen shared. Can someone chat if they see my screen or not, please? I apologize. I am screen sharing, I believe. Yes, you see it. Okay. For some reason, it wasn't showing up on my side for a second. Great. All right. So for in May, they pre-announced the 50 basis point hikes for May, June, and July, which was one of the first times they ever did that. And from how people digested it is they saw it as a way to calm the markets, to give guidance, and to try to be a systematic movement in these rate hikes, because there would have to be significant rate hikes. However, for those that were watching it closely, it was very interesting. The 4 days that was coming up before the meeting was extremely volatile, volatile in a way that was pretty scary, where there was ups and downs and a lot of selling off before the June meeting. And why that was the inflation data that we had just talked about was much worse than expected. And now the Federal Reserve has been seen as being behind the curve for a while. They were worried if they do 50 and then they're stuck to doing 50 in June again, they would be continue to be behind, and then inflation could get entrenched. So that's why those big sell-offs. So the Federal Reserve was in a tough spot where either they would have to hike more than 50 basis points to combat this new higher inflation, or they're going to have to follow their guidance. And either way, they're kind of lose-lose, where they have to break guidance and hurt credibility a little bit, or not do what's best and hurt credibility, and to hurt the economy possibly, because inflation becoming entrenched. So what happened is, I believe, once again, first time it ever happened, is the Federal Reserve leaked to the press what they were going to do. I believe it was to the Wall Street Journal, and they said that, oh, we're going to do a 75 basis point hike, and that was kind of a primer for the markets to be able to digest what the rate hike was going to be. So they came out, they did a 75 basis point hike in June to 150 basis point to 175 basis point range for the federal funds rate, and kind of backtracked on the whole 50 basis point. Their explanation was, and I agree with it, it was that the 50-50-50 was if we stayed on the same course, but because inflation data was significantly worse than expected, they were acting in the best responsible way possible. So a fair argument, and I'm happy they did 75 basis points, but it makes us wonder about what the future is to come. Are they going to go back to 50 for July? Are they going to stick with 75? And most likely is going to depend on what they say in July for the inflation data. September, November is pretty expected 50-50, and then December 25 or 50. So this is the dot plot that you can see. That's what the Federal Reserve shares to try to guide what the market should expect. And we would expect 3.25% to 3.75% Fed funds rate by the end of the year, which is about 175 to 200 more basis points of hikes. So that's pretty significant, and it's going to hurt, especially some of the growthier stocks. But a lot of that has been embedded in our current prices. For the rest of the year, it's going to be very interesting to see. Q3 and Q4 performance is very dependent on two things: is the Q2 earnings season and the inflation data. How I mentioned the inflation data is a lagging indicator, it's backwards looking. The same thing with the Q2 earnings season. So in July, this month, there's going to be incredibly important announcements from all the companies for what happened in the past 3 months. If they were able to actually live up to their earnings expectations or not. What a lot of analysts are worried about is stocks are very cheap right now, but that is based off of the current earnings estimates. If they miss earnings, then stocks are very expensive right now, and that they have farther to fall. So we're going to have to see how these companies are doing in the last 3 months, which were a very high inflation environment, which they haven't gone through for a while. Like the Q1 had high inflation, but Q2 had even higher inflation. So it depends on how much of this money, how much of these prices they can pass on to consumers versus they have to absorb. We will see. And inflation data, we really have to see that peaking. We have to see it slowing down. There's some good data we've been seeing so far. Crude fell, crude oil. Lumber has fallen. Copper has fallen. A lot of these commodities seem to have peaked. They're rolling over, which is the first good step. So we're going to have to see. Somewhat positive for the end of the year, but it'll probably, we're going to finish the year down most likely, but it's possible to keep going down. And we'll discuss that more. So next slide is the heat map. For those who have never seen it this way, this is how I look at the stock market every single day. The larger the square, the larger the company. It's arranged in the 11 different sectors of the S&P 500. You'll recognize Apple and Google and Amazon and Johnson & Johnson and Berkshire Hathaway and ExxonMobil. Anyway, so this month was quite bad. There was red across the board. Every single one of these metrics lost in July or in June. I left off our last meeting saying that I hope that in this meeting I would be able to bring you good news, but I didn't expect it. And the expectations were met that this month was tough. Last month, the end of the month, there was that bull trap I had mentioned where people were thinking was the bottom, but I believed, and many other commentators were believing, that it was a fake bottom. We would retest and possibly break lower, which is what we did. And it's possible we'll continue to go farther lower. We're getting closer to a bottom, but it is pretty tough. You saw that the S&P 500 fell over 8%. Small caps doing about the same, mega caps holding out a little bit better, which would be the Googles and the Microsofts and the Apples of the world and such. An important number that I want to point out is this global ex-US, which is international stocks, fell more than the US stocks did, 9%. And it's important to remember that inflation and all these struggles is a global problem. It's not subject just to the United States. Actually, the US dollar is appreciating against other currencies. If you look at inflation data is worse in other countries. So for us, we're complaining that the price of the gas pump is too high and the prices at the grocery store have increased. But in general, the US is actually doing better than the rest of the world. Europe is in a much worse situation because they're in closer proximity to the war in Ukraine, which causes more supply chain issues. But hopefully the whole world will be able to get out of this together when inflation starts to slow. All of it is stems from commodity prices, and commodity prices are slowly turning around, and these are all global markets. So we'll have to see how it goes. The aggregate bond index fell 1.5%, which is about expected, handling the downturn a little bit better than the market, but with rising rates, bonds will fall. Gold is a really interesting one to look at, which I have conflicting opinions about, because gold normally goes up when everything else goes down. It's a store of value. It's flee for safety. It is inverse related to most of these sectors. However, gold's also a commodity, and commodities are falling. So it seems like gold hasn't fallen as much as other commodities like crude oil at 7 and almost 8%, or copper or lumber have fallen. I think lumber is like down 40% or something like that for the year. Gold is kind of just flat, which is kind of what I would expect it. I see gold as a pretty good investment here, but it's possible if commodities continue to fall and the market recovers, gold will continue badly, but we will see. And that big number you see at the bottom, this is just this month. Bitcoin fell 40%, about from 30,000 to about 20,000. But it's because a lot of these .com bubbly situations are occurring where everything is falling through. I still have conviction in Bitcoin. I'm bullish, but it's important to have your expectations tempered and to invest only small amounts of your portfolio. Like, it shouldn't be 80%, 100% of your portfolio. You shouldn't be leveraging your house into Bitcoin. Like, people do crazy things into crypto, and it's really dangerous. But I think everyone that's attending, I know most of your situations are doing pretty well and are avoiding being too exposed to crypto or other problems there. Quickly talking about year to date. I don't know if you saw the headline. It's a very interesting headline, but we just had, this is the first half of the year, so year to date was the worst first half of the stock market in 52 years. So 1970 was the only one that beat out this year. This year's first 6 months was quite terrible. S&P 500 down 20%. But it's kind of expected. I've discussed it before, how it isn't a sell-off of panic. There is panic and there is uncertainty, but it's a revaluation of pricing because of rising rates and because of these commodities and inflation problems. It's very expected. This is how I expect the markets to be reacting, versus when COVID hit. We had no clue what was happening. Everything shut down. When 2008 happened, that was huge shock to the financial system, to its core. And 2001, the bubble, there was just crazy speculation, which we see in the crypto space. Whereas here, it's a downturn. We're in a bear market with down 20%, but I'm still positive, and in a it'll still be a volatile market in the coming 6 months, but investing for the long term is still a good bet, in my opinion. Quickly, we see energy doing well, consumer defensive, and healthcare and utilities and materials doing okay, with the telecom services and the financials doing okay. Most of this is expected. Those more defensive stocks versus the technology or the consumer cyclical stocks, which are inherently bad in a down cycle, which is what we're in. So I'll finish out this presentation talking about the notable risks before we go to the Q&A. It's the same 5 notable risks as I had put last month, which is the global conflict with Russia and Ukraine and the COVID-19 pandemic. One difference, China's zero COVID policy, it's still in effect, but China's reopening, which should A, help supply chains, but B, hurt commodity prices and rise them higher because they're not consuming a lot of these commodity prices. So we're gonna have to see how that all plays out. But both of these cause supply chain issues, which causes inflation concerns, which causes the Federal Reserve to have to raise rates and do quantitative tightening on their balance sheet, which are all risks in the market. One I added was the political instability and that the upcoming election season with Supreme Court ruling and how a lot of campaigning is happening for the elections in the fall. There's going to be volatility that is caused by the election. It always affects the markets, but it's important to note that most of this stuff doesn't impact the markets as much as people believe or are conditioned to think would happen. Most of the time, the market goes up, and it doesn't matter if it's under a Democratic leadership or Republican leadership. Statistically, it happens best when there's a mixed leadership and not much happens, because business often thrives under a low change environment. When things are stagnant, business leaders are able to find the best path forward for their individual business. So the last thing I'll say is a lot of this market is starting to become pretty attractive in terms of price. The levels keep falling, so the price becomes more and more attractive. If you have money on the sideline, maybe consider starting to dollar cost average it over the next 6 months. No one really knows when the bottom is going to hit. I would think it's over the next 6 months, probably the next few months. Next month, if I had to guess, would be up a little bit, and the month after that, a little bit down. And then maybe that would be bottom in August or September. But if you dollar cost average, you'll hit the bottom with at least some of your money, and it'll be some of the best investments if you get some of your money near the bottom. Of course, there are 6 risks that you see on your screen. NIVs could surprise to be worse than anticipated and cause the markets to continue to go down. But we will see. Hopefully all this will work out all right. So on to Q&A. There are already a couple questions I see that were submitted. If anyone would like to, there's the Q&A button at the bottom. All right. So the first question was the difference between the 2020 crash versus the 2022 crash, what I had mentioned before. The COVID crash was a lot of fear and uncertainty, and the market or the economy being shut down essentially. Versus 2022, this crash was more of a reevaluation in prices based on rising rates. Bonds and stocks fall when rates rise, and it's pretty orderly in my opinion. There is definitely panic, and there is stress, and there's volatility, but in general, as expected, all this stuff is happening as expected. So don't worry too much about the strength of our economy, in my opinion. I think the economy is pretty strong and will weather a recession if we get one. But we'll have to see how bad our economic situation gets over time. The other question was a pretty interesting one, was about Roth conversions. A Roth conversion, for those of you that know that strategy, if you want to learn more about it, I won't go too in depth. I'd be happy to talk to you. But Roth conversions become more impactful when the markets fall, essentially because it's expected to rebound eventually. And if you convert your traditional IRA when the market's down into a Roth, then all that gain from the rebound would be tax-free. So there are a lot of tax strategies that can be done, and a lot of them are more valuable, more impactful when the market is down. So there's a lot you can do with your financial advisor if you're my client. I have mostly already communicated with those clients that it would be useful or helpful to do Roth conversions or other kinds of strategies for. We have a good question. Is it better to roll an old 401k into a new one, or to keep it separate to have better diversity of investments across 2 accounts? So I wrote a blog post. I've been trying to become more active on my blog, have more resources for my clients and my community. And one of them, I believe, the top one, the one I just did, is called "Should I Roll Over My 401k" or something, and it talks about that. It goes through the 5 options that you have and the benefits and the downsides. It really depends on your individual situation. You can talk to a financial advisor like myself. I'd be happy to help you. And it depends if you need a loan from your 401k. It depends if you're going to do a Roth conversion strategy that can affect a Roth conversion strategy. It depends if you want to invest it differently than the securities that are offered in your 401k, because you're limited there versus an IRA. You can invest in anything. There is a bias to me because I can manage Roth IRAs here, traditional IRA rollover or Roth. So when I recommend a rollover, there is an incentive because I get paid for that. However, there's a lot of benefits to rolling over to an IRA. So that's tough because it's more of an individual question. Please check out my blog post. I have all that written down there. And if you want to talk about it more, I'd be happy to. I think those are all the questions I have. I had those 3 questions. I'll give it another minute if anyone comes up with something else. But other than that, how do we find your blog? Well, that's an easy question. I can, it's tougher to show here, but it's www.silverstone.financial and then /blog. Or you go to the homepage, there's a blog tab at the top, and it's the first blog post. It'll say 401k rollover. So easy to find. Thank you for the question. So I think if there's another question comes in, I'll answer it, but that should be everything for me. Thank you everyone so much for attending. Hopefully it was helpful. And again, like I said last month, I hope next month I have some better news. Sure, I can post a link in the chat. I can have some better news for everyone next month, but we will see because it's not a given, and there's going to be continued volatility in the markets. All right, here's the blog in general, and here is the 401k blog post for those that could benefit from that. The blog, I have a few that I'm planning to rate more about, but right now I have a blog post about I bonds, which are inflation hedged bonds. I have some about credit cards and rolling over your 401k. I also on the blog post these monthly market update webinar archives. So I post them on YouTube, and then they can be seen also on my blog if you don't know my YouTube channel. So yeah, the blog is a great resource, and I'm hoping to expand it and make it even more of a great resource. So yeah, you're welcome. So that's it for me. Thank you for coming. I hope you have a great month, and I'll see you guys next month. Thanks.